50% of our panel is here, but we'll wait. It takes time for alts to go into the mainstream, so maybe that's apropos for why we only have one of our two panelists sitting here. So I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures. We invest in early-stage fintech companies. I also founded a podcast called Alt Goes Mainstream, talking about how alts are going into the mainstream, really informed by my time at iCapital, where I was an early employee and investor. And here we have Shannon from Neuberger Berman, and she's spent the majority of her career investing into not just alts, but other things, but has a great perspective on alts. So I'd love for you to start talking about kind of how your career arc has followed the arc of alts now going into the wealth channel, not just the institutional channel, like Ben said.
Can you hear me? There we go. So one of the things that we were talking about when we were talking about doing this panel was I was thinking about how different my experience in selecting product, for instance, was when I started my career 20 years ago. For many of us, we're here, we're advisors, we're in the advisory world. The only people that were calling on me 20 years ago were wirehouse wholesalers. And so if you think about the trajectory of back in 2006, for instance, think about who was buying alternatives then. Institutions, everybody was trying to emulate the endowment model, but you really can only do that at the time with very large pools of capital with minimal, if no, liquidity requirements. And so then we kind of crested into the, hi Stephanie. We crested into this new phase where there was an outreach by certain firms, particularly in the family office space and the ultra high net worth space, in trying to capture these types of investors for alternatives. Then the GFC hit, and there was a lot of concern about gates, liquidity. What did it really mean to get liquidity in that environment? And it was incredibly challenging. Then the advent of the liquid alt space, those hedge fund replication strategies that were designed, if you will, to mitigate some of the outcomes of the GFC. And as we've moved into the last 5 years or so, I feel like we've swung back to an area where there's a desire to be able to provide particularly high net worth investors with options that can potentially enhance the risk reward of a traditional 80-20 or 60-40 portfolio that's in liquid assets. But I think we still have a long ways to go in terms of understanding when, why, and how to do that. But at least now, the channel is seen as an opportunity for firms to come in and attempt to build solutions. And I think that the voice of the advisory firm, of the RIA in particular, is growing. And so hopefully that will lead to kind of better product enhancement innovations as we move forward.
I think that's a great transition into Steph, who maybe lockup also refers to LA traffic. So we apologize. It's running a few minutes behind. But last but not least, we have Steph Drescher from Apollo, Chief Client and Product Development Officer, who also has seen this career arc of working in the institutional world, but now working in the retail channel on the alt side. So would love for you to talk about, just as Shannon did, kind of shared how her career arc also kind of coincided with the career arc of alts going into the wealth channel and mainstreaming.
Yeah, so great to see everyone, and my apologies again for arriving late. It's terrific to be here, and my roots from a career perspective started in wealth. So I actually spent nearly my first decade at the JP Morgan private bank, specifically for the lion's share of that time in alternatives. So I saw the very early days of how, at least in that case, kind of the family office crowd, the high net worth, ultra high net worth, started to add alternatives, which in that definition, I would say is the more traditional definition of private equity, long dated, episodic, some hedge funds, some real estate. But you really didn't see at that time alternatives on the front page of any newspaper. And the channel was quite narrow in terms of who ultimately was engaging with those types of offerings. So I was there until 2004, when in my prior seat at JP Morgan, I met the senior partners at Apollo. And they asked me to join. And at that point, Apollo was sub 15 billion in AUM. And principally focused on alternatives, some early days of credit, but the organization was really just starting to build out what it would then kind of take hold as the the client and product solutions area. So I very much tilted, as Michael was saying, towards the institutional build out globally, and spent the last almost now 20 years at Apollo. And most of that time, up until about 2 years ago, was very much focused on the institutional side of the business and those clients, those products. And the last 2 years has been incredibly fun because we have built out a global wealth business that's focused on everyone from the mass affluent through to the high net worth. So the advisor community, RIAs, IBDs, wires, private banks, and family office, to ensure that we can speak to alternatives in the current definition, which we'll talk more about, and service those needs. So I've definitely seen kind of the arc from a very select small group of investors globally having access to alts, to shifting to institutional, and then delivering those products to wealth.
So, question for both of you. Why now for alts in the wealth channel? Maybe start with defining alts. Like you say, I'd love for you to both share your definitions of what alts means, because I think different advisors may think about alts differently, or they may need to structure things differently for different types of advisors and their clients. So start there with what does alts, how do you define alts, and then why now for the wealth channel?
Okay, maybe just jumping in. So the definition I like to use of alts is simply an alternative to public stocks and bonds. At the end of the day, that's really what it is. And allowing advisors to speak about a portfolio that's historically been dominated by public exposure as a more diversified mix of public and private. Because why shouldn't all of the clients represented by the amazing advisors we have here today ultimately be able to generate excess return per unit of risk by taking on some additional illiquidity? And at the end of the day, that's what we're speaking about. In order to deliver on that excess return, you do need to take on some additional illiquidity, but sometimes that can be quarterly as opposed to daily. But thinking through in the world of alternatives, how much liquidity does one really need on Tuesday as opposed to throughout a more measured period of time, and layering in the alternatives that could be in what's otherwise a debt portfolio, in an equity portfolio, in a real assets portfolio, and thinking holistically about each of those sleeves as either public or private over time, and no longer thinking of alternatives as that traditional definition of kind of the long-dated stuff over here.
Shannon, what would you say?
Well, I think I wouldn't disagree with the definition of alternatives, but what I would say is why now is that we're entering into, or we've entered into, a different type of time period. If you think about the efficiency in the marketplace, that continues to increase. You know, you went from large cap stocks here in the US becoming more efficient, to small caps, now to international. Now we're even at a point where there is so much transparency, even in the bond market, in a traditionally very inefficient market. There is not as much value or alpha to be captured. And yet, there are still areas of the market that remain inefficient, whether it's due to coverage or due to liquidity. There's also been changes in the way that I think we think about building portfolios for client solutions. So there's a number of factors, and we talk a lot about factor analysis. But one of the things that I think we really think about at Neuberger Private Wealth is, what about time horizon as a factor? If you think about, we talk about it in terms of risk tolerance, but it should be incorporated into the building of the portfolio. And so what does duration mean when you're actually building the pieces of that portfolio? How do cash flows potentially play into that? And where can you potentially balance out some of the risk of illiquidity in that time horizon with the really inefficient, very liquid parts of the market? it's a more dynamic way to think about things, but it affords investors the opportunity to access parts of the market that haven't yet become more efficient. And I think that's what's so exciting about it, is that alternatives today are going to look one way. Alternatives in 10 years, there's probably going to be different things that are alternative to all of us then than they were today in this, or 10 years ago.
It's a great jumping off point into the next question, which is around the productization of alts. So you both have different vantage points. Shannon, you're at Boston Private, allocating to alternatives as a wealth manager with that hat on. And Steph, you initially worked mainly with the institutional community, but then have worked with the wealth channel now at Apollo. How do you think about, from both of your perspectives, how do you think about the productization of alts when it comes to working with the wealth channel? Because there are nuances with the wealth channel that you may not have with the institutional channel. So how do you think about that? And then how did you think about that from the other side of the table as potentially the buyer of product?
Yeah. Look, the way we think about it is the actual underlying investment, the asset that we're purchasing, we're agnostic in terms of what vehicle that is ultimately allocated to. We want to find the best opportunities at the investment portfolio manager level, and then each PM will decide what's appropriate for their respective vehicle. So we think of the structuring simply as access points for a portfolio that is entirely consistent with the best-in-class investing that we would offer to any client across the firm. So whether a client is institutional, family office, RIA, et cetera, the investment itself will be exactly the same. The ability to access it, though, we've been able to use all the creativity over the last couple of years since we've strategically focused on building out the wealth segment at Apollo on, frankly, exactly this question. And it's been a ton of fun at first listening to what is the community of intermediaries, of advisors solving for. What ultimately will make it that much easier to allocate within a client's portfolio. And so we heard early on, one-layer fees, easy access through ideally a tech solution, tax reporting, J-curve management, so seasoned portfolios, and making sure that they don't have to wait 3 or 5 years to get access to that private markets diversified portfolio, currencies, regulatory issues. And so what we set out to do, and now we went from 0 perpetual product semi-liquid 2 years ago to now 7 strategies with many multiples of that in terms of the different geographies and underlying share classes to make sure that it's fit for purpose and really speaking to the needs of the wealth community. So I think what we're seeing now in the market is institutional quality product that is designed specifically for the needs of each of the respective communities of individuals through their advisors, ultimately across asset classes, and with the liquidity and response to all of those initial challenges in a very constructive way.
As a consumer, I think we all need to be very realistic that there's no free lunch in this or in anything else, right? If you're in the best case scenario for any asset is that you have an unlimited time horizon with very little transparency, and you are not forced at any point to liquefy that asset, because that gives you total optionality in terms of the return of that investment. That is not realistic for most clients, for most people. It was realistic for David Swenson and the Yale Endowment. It is not probably realistic for any of us sitting here. So each of those incremental changes that you make, going back from that and taking, more liquidity, shorter term time horizon, shorter term investment period, terms that have 10 years or 7 years or 5 years, all of those you should expect that there could be some potential slippage in return along that shift downwards. That doesn't mean that it's not worth it to include those into the portfolio, but really understanding to your point, the underlying asset, how much slippage potential there is in the structure, what should the liquidity buffer be, what is it worth to you to pay for that liquidity? And in many cases, it could be very well worth it. But you need to understand that, and so I think when we talk about product, we would love to see a number of the same strategy, if you will, the same pool of capital, the same bright minds on a product that's structured in different ways for different types of clients. That's sometimes possible and it sometimes isn't, but it's really important to understand what you're giving up because there's almost always a trade-off in the way that products are structured.
When you say that point, it makes me think about something you said a little bit earlier, Steph, which was that people shouldn't think about alternatives as this far away satellite bucket, but it's really just part of equities exposure. It just happens to be maybe private equity or credit exposure. Maybe it's private credit. How would you both think about that concept when it comes to the evolution of the portfolio? I know the advisor world has talked a lot about moving away from the 60-40. What does alts do to, and the way of thinking about alts do to that concept that I think maybe we've reached that point of change? How would you react to that, Steph?
Look, if one truly thinks of alternatives in the definition I mentioned, just an alternative to public stocks and bonds, then what is the right percentage for alternatives across the entirety of the portfolio? And as we step back, if an alternative can be anything from a AA credit through to equity, then to be controversial, why isn't private markets 50% of a portfolio over time? It goes back to what is the liquidity tolerance and capability of the underlying client? How does it fit in? What are the structures ultimately that slot into those categories? But I do think that thinking about one's debt exposure and then looking at the excess return that alts can deliver, look, in today's market, a private credit strategy, even in a 5% quarterly liquidity structure, can offer 12, 13% over the past year, if we look kind of at performance, with first lien type of exposure. So large, stable credits that, in our view, can do well throughout a cycle, given the unknowns in terms of where we're heading economically. And if you contrast that top of the capital structure exposure with yields, that was a total return I mentioned, but yields, let's say, of 9+%, compare that to public yields of credit portfolios today. So doing an analysis of how much excess return can I get, what's out there, and being able to ultimately now invest with the managers that will deliver the institutional quality product, because that's what the advisors deserve.
I want to touch on one point and ask Shannon, because you've seen this from the perspective of the buyer of product, but as a CIO, you have to educate the advisors. You may want to implement an investment strategy or policy, but then you have to tell the advisors why this makes sense and educate them, and then they have to educate the client. With what concept that Steph said that you've talked about before, how do you think about advisors and CIOs can go about that challenge? Because that's a part of it, it's multiple layers of a sale almost, or an understanding of a product.
Well, I think the reset of what does alternatives mean, and it's really just a different way to access a different type of the market. So I think if you start with the concept that you have a bucket of alternatives and you're trying to educate on this bucket of things that actually are very inconsistent across the board depending on the strategy and depending on the exposure that you choose, that's where you're already getting off on the wrong foot. I think with education, we've done such a great job over the last 30 years in thinking about long-term time horizon, diversified portfolios, strategic asset allocation, dollar cost averaging, remaining in the market. Nick was up here earlier. He does a great job on this. So I think what we need to do is we need to think about just educating on the expanded opportunity set that implementing privates in your portfolio, implementing illiquid strategies, implementing perhaps even more tactical strategies into your portfolio makes. And also having clients understand the why. Why are these things in the portfolio? It's not for any particular product. If you start with a product sale internally to your advisors or to your clients, you're dead in the water, right? Because that doesn't create the intellectual curiosity and the understanding for the future state of being able to continue to add these portfolios over time as different parts of the market become attractive. And we could talk a lot about private credit versus private equity right now. We have a little bit of a different view on that maybe than other people do at Neuberger Berman, but it's really important that you set the stage the same way that you've educated your clients about everything else that we've talked about that's become standard. Just think about that. 35 years ago, what I just talked about, a multi-asset class portfolio across, diversified for the long term, that was really not how wealth was managed then. And so I think it just requires this entire shift in mindset of including it in a holistic portfolio solution and not in a bucket at the bottom of your performance report.
I want to get into a little bit of controversy. That would be great. First, before we go there, though, I do want to ask, because I think that good to be open and hear that this is an evolving space. You've both kind of started this journey more recently, working with the Wealth Channel in certain ways. So I'd love to hear what your biggest challenges have been thus far. What do you think your biggest learnings have been from that? I'll start with you, Steph, and then go to you, Shannon.
Look, I do think education and efficiency of access through tech solutions are two areas that have come a really long way. And on the education front, just building on what Shannon said, I do think making sure that we can deliver tools to the industry to ultimately just make it that much easier for financial advisors to better understand the strategies that are the building blocks for alternatives in a portfolio, and the why and the how. I think that's super important. And so I've been amazed at the uptake that we've had through apolloacademy.com, and we deliberately made it public to anyone that wants to use it. And the fact that you could actually get CE credit has gone a long way. But I think that's a starting point. So more tools out there to make sure that everyone feels really comfortable, so that we don't end up in a situation where only a small segment of advisors and therefore clients are users, but rather a much kind of broader set of those that are comfortable. And I think that's growing every day. So in terms of the tech side and your roots, I think as an industry, the fintech solutions, the iCapitals, the cases, they absolutely make the process, as certainly of the private structures, that much easier for the advisor community. The interval funds now, if you think about it, I mean, the minimums are $2,500, and it's point and click, right? So we are at a point where it's become much easier to access, but I think over time that will only become more and more improved.
Shannon, we talked a little bit about this. I think you said something that Steph also touched on, which is that the infrastructure is the biggest challenge in the alt space. Is that something that, how do you think about that now and also going forward?
Yeah, it's if you're sitting in a large pension plan and you have to fill out one set of sub-documents for a $100 million investment, it's a lot easier than for 1,000 clients. I think there's two parts to that too. I do think that we've made a lot of strides, and there's a lot of great fintech folks here in terms of finding solutions to different parts of the problem. The challenge is that we're all trying to deliver an extraordinary client experience. And so not only are you asking your client to potentially allocate money for which they will not see an immediate return, you're also asking them to fill out a lot of very complicated paperwork, or at least sign that complicated paperwork, providing you've walked them through it. But then you are providing them with reporting that looks different, feels different, comes from different places. And so I think that for the majority of advisors, particularly if you're trying to scale your business, there is probably the onus is on folks like Neuberger Berman on our private market side, Stephanie and Steph and her firm and their group, to be able to start to marry what we provide out to individual advisors, being able to help in that process of being able to systematize, if you will, the delivery of that, because there's nothing that makes clients more anxious than something that seems out of date, not accurate. That makes that lack of transparency that they're already feeling even more pronounced.
Okay, I'm going to move to a quick fire round. Quick answers, one or two words or sentences. Maybe we'll get to that little debate between private equity, private credit here. So, most popular investment product in 2024? Steph.
2024.
Yep.
I think private credit will continue. Alternatives to public equity, I'm giving a few. And I do think increasingly climate, as investors think more broadly about what they can do in that trend.
Great segue from the last panel. Shannon.
So I would say probably private credit in 2024, but I would say that there's a lot of talk right now, and Neuberger Berman has done a great job of outlining this on it's either private equity or private credit, and I think people are falling on the side of private credit. It's actually both, right? Because although private equity has to pay a little bit more potentially if they're utilizing debt in this environment, that debt is going to be refinanced in a few years, and they're still going to have a very long runway to monetize those investments. So we're actually very optimistic on both private equity and private credit, although that seems counterintuitive, if you will. I think next year, too, you're going to continue to see a lot of secondaries on the market. I think that is an opportunity, not only in private equity, but in private real estate. People have been waiting for liquidity, and that's a good place to be looking at this point.
Michael, I'm going to add on. I'm going to underscore. I agree with you on secondaries. And I think we also need to keep our eye on real estate, because once you head into 24, you could see that as an interesting space going forward.
Okay, so now fast forward 5 years in 15 seconds each. What does the alt space look like in 5 years?
Look, I think we're going to continue to see innovation. We'll see a suite of products that help to plan for retirement in a smart, tailored way. I don't know if it's 5 years when advisors have it on their app, but over time it will become as efficient to invest in as we see the daily markets.
And I think we see a number of different strategies that are really focused on that duration of assets, that time horizon, those types of longevity assets as part of a portfolio. I think that balancing that out as a factor is going to be incredibly interesting in building portfolios for the next 5 to 10 years.
That's a fantastic way to end. Thank you both for sharing your perspectives on alts.
Thank you.
Thank you.
Appreciate it, Michael.
Thank you.